Well, you can't get a market more bullish than at all-time highs. Now, we've got that in the Dow, the Euro stocks, the DAX, the CAC, and the Nasdaq and S&P are not a million miles off at the moment. Now, Powell's opened the door to rate cuts in 2024. He hasn't pushed back on market expectations. He's done what is effectively a pivot, and bond yields have been crushed. The US dollar's fallen in appreciation, and we've seen a strong rally in gold. Now, Mr. Powell passes the baton on to the ECB, the Swiss National Bank, the Bank of England, and also to the Norges Bank, hoping for a quiet Christmas. You got it wrong. This is the trade-off. Well, hi, I'm Chris Weston, Head of Research here at Pepperstone, and I'm going to bring in Mr. Blake Morrow from Forex Analytics in a second, just to talk about everything we've seen, and it has been a pretty emphatic move across markets. But can it last? That's what I'm going to ask Mr. Blake Morrow. Mr. Blake Morrow, coming to the programme. We have a lot to talk about in topical funders, so I don't want to talk about it for too long, but I woke up early this morning. I had to see the Fed meeting. I suspected it was going to be somewhat hawkish given the market pricing, but as soon as it dropped, it was on, and it was people reacting. Volume spiked up. I think a lot of people were surprised by just how aggressive the moves we've been seeing across the bond market, across the dollar, equities moving higher. How has the last 2 hours been for you and your community?
Well, it's been a wild one, and we're going to talk a little bit about some of these moves and why we're seeing them extend as far as they are. But I'll tell you, couldn't have got a more dovish Powell. I was a little stunned. There wasn't any pushback whatsoever.
There wasn't, mate. Anyway, let's just go straight into it. Let's go topical funder and talk about the Fed. We just talked about it there in the synopsis there, but we've seen a situation where I think the initial reaction was about the dots. I think, were we going to get 4.875% for next year's dot, implying two cuts, or are we going to get it at 460, implying 3? The market saw 3 rate cuts coming through. Even though they were positioned more dovish, I think they've seen a situation where the Fed have come closer towards them. They've lowered their peak core PCE projections for next year and also for 2025. The Powell came out in the press conference, as you said, there's no pushback at all. I think it's unequivocally dovish what we've been seeing from Powell. So, ultimately, what have you taken out from this and the big moves that we've been seeing in yields across the front end, what we're pricing in rates now? Can it last?
Well, so this is where you start. First of all, let's go backwards, and you ask, can it last? We're going to talk about this in a minute as well. We're getting into that period in the markets where you're either going to get on the train or you're just going to get out of the way. There's 2 options here. You can try standing in the way, but it could spell trouble. And right now you see the dollar continuing to weaken, stocks continue to rally, and FOMO is in full effect. Everybody's chasing the market higher. As the market moves higher, percentages that you have to make up as an asset manager have to increase as well. So you're gonna put that pedal to the floor. And I go back to what you just said. There are several other central banks that are still waiting in the wings here in just less than 24 hours away from right now. So a lot can still happen. Just after the close, I think we saw like Adobe was down. We saw some stocks, U.S. equities were down on guidance. It's tricky though. No one wants to stand in the way. But I must admit, Powell was just not dovish at all. When the conversation of rate cuts comes into the sphere of the FOMC, that this is now going to be top of mind for the markets going into the first quarter of 2024.
Yeah, I mean, I think Chris Waller started this off on the 29th of November, giving an explicit path to easing. And Powell actually said, we are talking about easing. We did talk about easing at that moment. Does that constitute a pivot from the Fed? I think it does. I think the market's taken it that this is the pivot that we were looking for. looking at rates pricing now, Blake, we've got an 85% chance that the Fed cut rates in March. I'm going to throw a question to you before we go to central banks. It's a lovely segue in. 85% chance of a rate cut in March. You've got 140 basis points of cuts from this time to December, but we're going to ECB pricing, and we've got 150 basis points of cuts, but they're also about 60-70% chance that they cut in March. So the race is on. Who is going to be the first central bank to cut rates in 2024? Is it going to be the Fed or the ECB? I think the ECB have far more scope to cut than the Fed at this stage. What do you think?
Well, I would agree with you. But tomorrow, and let's go ahead and move to the next topic, we have the ECB. We have not only the ECB, we have the Bank of England. We have Swiss National Bank. We have the Norges Central Bank. We have Banxico. We have a lot of central banks that are coming up, and the ECB is going to be front and center. And going into this meeting, going into this ECB meeting, a lot of people, a lot of traders thought maybe the ECB might give a little pushback. But taking the lead from Jay Powell, do you think Christine Lagarde is going to kind of take the mantle and run with it right now? And same with the Bank of England. And I think the door is open. Now, you said you think the scope for the ECB to cut them sooner, quicker, faster. I agree with all of that. But tomorrow is going to be critical to see if Christine Lagarde leaves that potential out there. Because what's really interesting is I was talking with some of my colleagues and in our community, following the Fed and during the Fed, that now you got other central banks that are going to be meeting, and they're going to be, giving out their statements and how they feel about the respective economies. And if all central banks are just dovish, well, equities may continue to rally, especially you take the German DAX and other equity markets as well. But you might have currencies go back to where we were just at. We saw some weakness of the dollar, and the euro might slip tomorrow. Maybe the sterling slips. So it's going to be a really interesting 24 hours. How are you positioning yourself with the ECB and Bank of England and, Swiss National Bank, which by the way, I think the SNB is going to be a little bit more dovish. I think they're going to be hinting towards rate cuts themselves. But how are you taking the next 24 hours?
Yeah, I was going to say, I think if you're going to see a central bank being more dovish than the others, I think the Swiss National Bank has a higher propensity to do that. I actually think that the Norges Bank in Norway could be a really interesting one. The market's pricing about 7 basis points of hikes. If they're, I think they're the only central bank who are likely to hike. I think the market's underpricing that. So, I actually like being long Nokia against the Swedish krona. I think that's the trade that I like on the back of that. But I think the interesting thing is that, they absolutely do have a lot more scope to be dovish. When the Fed have opened doors, the Fed typically lead other central banks in the cutting cycle. And they've got more scope to be dovish now. So she would have definitely said if we were sort of sitting on the fence, they can open it a little bit. And like you say, inflation in Europe has just been absolutely crushed. Go back to what Isabel Schnabel recently said. She said that the fall in inflation was remarkable. They're under 3% now, and it was 10%, late last year. So, they've got scope to cut, and they've got scope to cut far more aggressively than the Federal Reserve, given where growth is, given where bank lending standards are at the moment. So, I think that they could do. I don't think they will, though. And I think there's a big focus on the reinvestments of their PEP program. When will they start? That quantitative tightening and much more aggressive, rather than reinvesting the proceeds and keeping that consistency. They're going to let them run off in a much more aggressive fashion. That could be euro positive. So I think trading the European Central Bank meeting, I think, is actually really tough. So I wouldn't want to be overly exposed to that. For me, if I've got a position on post the Fed meeting and it's sitting nicely, short dollar position, I'd be closing it ahead of that ECB, because it could go either way. I think that if you look at the distribution of outcomes, Blake, they're both ways. I do think that you're right. The Swiss National Bank is probably going to be slightly more dovish. There's downside risk to the Swiss, but I like that Norges Bank. The market's giving a very low probability they hike. I think that's underpriced. So I think there's some juice potential in that trade.
I like how you're trading the Naki Saki. I love it.
Yeah. I think it's a good one, and obviously the Nokia was one of the best performers last night as well. So anyway, I want to flip it to risk on. Because this is the question that we're fielding at the moment. You know, we've got a lot of clients, a lot of traders who are looking at the Nasdaq, the Russell, US 500. European markets, you know, they're breaking out all-time highs. It's like, I think you made a really, really good point in the Fed meeting. Don't stand in front of this market. You're either flat or you're long. I think obviously you can get a trade in the very low time frames, but I think if you're trading, you know, big picture stuff, then these markets are on fire at the moment. You know, I think the market knows that on January the 1st, there's a ton of cash coming into the market, trillions of dollars. You know, I think we want to wait until the VIX expiry on the 17th of Jan as a big potential turning point. But for now, the chase is on. I think a lot of active managers, if they're significantly underperforming, there's no point in chasing it. But right now, you know, there's hedging flows going through, FOMO flows going through. You know, I mean, you've got an ultra dovish Fed that's come through there, and so like you're right, the ECB meeting could do it, but I still think these markets go higher. I know a lot of people disagree, but I think the balance of probability right now, by pullbacks, it's going higher still. How do you think it?
I'm with you, Chris, and I know you're going to actually talk about the S&P here momentarily, and so make sure you all stick around because we're going to take a technical view, or at least Chris is going to take a technical view of the S&P. But I would put a floor in the market wherever you might visually see it and say, look, as long as we're above this level, we call it the bull bear line. You know, bullish above this level, bearish below that level. As long as you're above, you know, in this case, like 4,600, if you stay above 4,600, there is no reason to be on the short side. And remember, seasonality is in play right now. I thought that maybe Powell, if he squished the market, catch, you know, the market off guard, you know, some traders that have been chasing the market, but the chase, as you say, is on. And so you either get on the train or get out of the way, you know, and it's at the end of the year. Don't try to make it up.
That's a great analogy. I think that's the case. But I think the other thing as well, Blake, is how many times have we seen a situation where we see big moves from a Fed meeting and then next day it does something completely different? So that's something. But I think in this situation, I don't think you can construe what's gone down any differently, you know.
So let's staying in the subject. Let's talk about tomorrow really quick. Going back to what we were saying about central banks, what would any other central bank say that could really derail the current global equity market rally? I mean, you'd have to have. Now, I do have to point out, boons are at really key resistance right now. If you look at the German boon, so there's a little bit of a risk there that maybe the ECB is really hawkish and the euro turns and you see a turn in the boons, and then maybe the 10-year starts to fall here in the US and yields start to rally. I don't know, but what can central banks do?
I think more importantly, Blake, and I'm not dismissing your question because I think it's the pertinent one, is whether the market actually believes a word they say, even if they are hawkish. Because there's no reason to be hawkish. The Fed had every reason to be more hawkish than market pricing. They weren't. So when you've got a central bank that has scope to be dovish, like the ECB, and we've seen Isabel Snarble, a known hawk, come into a much more neutral setting, why would they be more hawkish? But then again, you know, the market believe them. When the market's pricing in 150 basis points of cuts from the ECB, and the ECB push back on that. The question is I think the more important question is, if they were hawkish, does the market believe them? And I don't think they will, to be honest. I think they've made up their mind that cuts are coming, and I think Christine Lagarde is a lagging indicator.
I know my colleague Ryan Littlestone is going to definitely disagree with you because her tan indicator is one of the best in the business. So
yeah, she's got a good tan. You wait till the end of the summer, mate. I'll be there as well.
Right, there we go. Okay, so let's turn it to our last topic, which is holiday trading, and this is an important topic for us traders as we head into the end of the year because liquidity really starts to dry out. It's going to dry out after tomorrow, and then really bad after the BOJ next week, which we didn't even discuss the BOJ, Chris. And I think we're going to be talking about the BOJ next week. But the point of this topic is I've traded so many holiday periods, and I know you have over the years. You know, when moves start happening and they start developing, it is a really, really difficult time to be trying to play some revision type of trade when there's just flows driving the market. Because, and I'm going to talk as a trader, what the propensity of most traders are, myself included, is to find some good levels to fade the market. You know, you whether it's a good Fibonacci level or it's a big extension, maybe relative strength is overbought or oversold, you're reaching past a cloud, whatever the technical reasons you want to start fading markets. This is not the time I've found historically that you want to be doing that. So you're either in a trade, you're letting it run. If a trade starts to get away from you, cut it quickly. Don't let those losses build this time of year, because it's really difficult to make them back. And if you're going to fade some sort of move because you think something's overbought or oversold and you want to stand in the way, draw a line, put in a stop, and don't touch it. And if you get stopped out, you get run over, so be it. You took the risk. But I'm just warning people, holiday trading, you get a lot of flows. We're end of month, end of year. If they're coming through the market, be careful. Do you want to add to this, because it's such a big topic for traders?
No, I think you're absolutely right. I mean, I would say if things are going badly, cut the loss. That probably applies to all through the year.
Always, yeah.
But I mean, I think when we've got this pricing coming through the market, if the data still matters, right? So when we start seeing, I mean, we're probably not going to get a huge amount of data this year, but I think when you've got this pricing, we're going to get some outside reactions to positive US data. We've got retail sales also in the session ahead, and that's going to be interesting. But then you add in liquidity, and you can get some pretty pronounced moves. So you've got to think about how much risk you're taking on a position and just get out, because But I agree. I think what happens at this time of year is the big boys take it off. They say to their juniors, these are our core exposures, massage them around the edges, take a little bit off, but keep them going on. And they just want to just keep the flow going really in this time of year. But I think top of book liquidity dries up a little bit, spreads widen a touch in the underlying markets, and that can the ability to move prices around obviously increases. It doesn't take much to move something around that may have been harder. So that liquidity is absolutely an essential part of trading, understanding what's liquid, what's not. Am I going to get slipped down the order book in terms of your fills? These are all stuff that we have to be thinking about in a period where liquidity comes out of the market for sure, 100%.
Don't try to make your year in the last 2 weeks of December. Let's make that a rule.
That's right.
How about that?
Yeah. All good. Anyway, let's go to that's a setup and see some of the charts on mind. Well, I'm going to bring out dollar yen. Got a bit of a run through last night. I think when we saw 2-year treasuries dropping from 4.66 down to 4.24, real rates having a strong move, and we talked about what was being opened up into the swaps market in terms of an 85% chance of March. Dollar yen just really moved tick for tick. I mean, it was just, you might as well have been trading one or the other. What was the cheapest expression? I think it would be interesting. I made a sort of a joke that, the Ministry of Finance, the Bank of Japan, it would be one of the funniest things today if they were to come out and intervene, because that would be like that would fall off your chair moment. Obviously, it's not going to happen, but if they were momentum traders, they could cause dollar yen to move down to 130 or so. So obviously they don't need to do that now, so that intervention's off the table. But I mean, I think if you're trading dollar yen, you're making a play on what's happening on the front end of the curve. We're seeing a decent bull steepening playing through, and it's a good thing for risk in this instance. So I like this lower. I'm selling rallies. I haven't drawn a 5-day exponential moving average, but I think all rallies are being contained into that. I think it goes lower, Blake, and this is starting a trend. How are you thinking?
Well, I like it, especially I like it below the 200 DMA. We get below the move below the 200 DMA. I think it opens up a test for 140. Isn't it interesting with all of this intervention and talks and words of warning from the BOJ? Wouldn't it be interesting if from the Ministry of Finance and the BOJ really didn't have to intervene in this move and we end up seeing a move lower? But I have to say, and I do want to point out, and I just said it just a bit ago, boons are at really key resistance ahead of the ECB. The 10-year, which 10-year yield and and the dollar yen have a very, very strong relationship. And that relationship may reassert itself now that we're past the FOMC. We might see us a little bit more sensitive to what's happening in yield. So I think you have to just be a little bit careful tomorrow. Yields should continue to drop. And if they don't, then be careful with your short dollar yen open positions, I guess I'd have to say.
That's right. I mean, I think as well, obviously, we look ahead for the Bank of Japan next week. Are they going to give a clear signal that they're going to be raising rates pretty soon? We saw a pretty impressive Tankan report yesterday. Obviously, we're looking for the wage negotiations, some more colour around that. But I think all the signs are they're going to raise rates, but it's going to be 10 basis points and then maybe another one next year. But is next week's Bank of Japan meeting a volatility event for the year? Something we do need to think about. The other factor as well is that being short dollar yen does come with a carry cost. So people loved it on the way up because you got a really nice trend and you got paid to be in the position. So being short dollar yen comes with, you have to have conviction on it because obviously it costs money because of the carry. So that's a factor. But this is the consensus trade for 2024. Long yen is the consensus trade for 24 and it's playing out before it actually happens, right? So we'll see.
Yeah, that's right. Great chart, Chris. I like it. So my first setup is going to be the Euro Swiss. Now, we talked about the Euro Swiss a couple of weeks back. I remember on the show, and correct me if I'm wrong, Chris, we talked a little bit about a false breakdown. I ended up getting long some Euro Swiss, but I'm looking at it from a divergent central bank play possibly tomorrow. Because if you get a little pushback from the European Central Bank, but you do have the Swiss National Bank that is a little bit more dovish, that Euro Swiss, a move above 95 cents is bullish in my book. Now, I am long some. So I'm going into tomorrow being long from lower levels. I've already taken some profits off of my position over the last couple of weeks, but I'm looking to add back on a move above 95 cents. I am then looking for a move back to the 50 DMA. As you can see, my arrow there. And that's how I'm going to play the Euro Swiss. How are you looking at the Euro Swiss right now?
Yeah, well, I think, excuse me, if you look at rates pricing, we've got 150 basis points of cuts being priced into European markets. You've got 68 being priced into Swiss markets. Now, from that perspective, and the fact that the Euro Swiss is going up, that's a very big positive for this trade. We've priced in so many more rate cuts in Europe, but yet Euro Swiss is still going up. So that tells me if we get any situation where Lagarde pushes back and we get, say, 150 basis points coming down to 140, Euro Swiss has got upside. I think the Swiss National Bank could be one of the first to cut. I think we could see the door open today in a dovish fashion. So fundamentally, given what's being priced, I find it very difficult to believe Lagarde is going to outdove a market that's pricing at 150 basis points of cuts by December next year. So from a fundamental perspective, I think this makes sense to go higher. I think it does. And the technicals are already in alignment. The market's already saying they believe that's the case to be true. So I like your trade. I think this goes higher. I think this is a good chart, and I want to be long. I wish I was long. I'm not. I want to. There we go. US 2000. Let's go to that one. Now we talked about consensus trades. I think one of the big consensus trades that's brewing is, this year was obviously all about Mag 7, tech, AI. People are saying, I heard this from a number of banks who are recommending the US 2000 or the Russell 2000 as their index of choice for next year. We won't go too much into that because it's obviously a massively technical side of things, but we've already seen, if we were to do my classic pairs trade of the R2K divided by the NASDAQ or the US 500, we are seeing outperformance from the Russell. And it's already doing that. We saw a 3% move on the day when the NASDAQ was up, 0.8% or so, the S&P just over 1%. So the Russell is outperforming. The market's already saying they want to be long this market over others, and you can see that in the technicals. It's a beautiful chart. I'm buying pullbacks in the US 2000. I like the Russell as a pairs trade, long Russell, short NASDAQ as a relative trade there. So I think this is one that's doing well. It's hot. It's really hot. We'd look at the close above the Bollinger Band. It's really hot, and so any kind of pullbacks I think is a buying opportunity. How are you seeing it?
Well, first of all, I don't follow the CFD that you guys have being here in the US, so I tend to look at the IWM. But what I know about the Russell 2000 is it is not quite at the top of its 2-year range. So there's a lot of upside, I believe, available to this index. So if we continue to see this rally that we're seeing in, not only European stocks, but in the S&P and the Dow and everything else that's moving, why can't the Russell play a little bit of catch up and make it up towards that resistance that you see in the middle of your chart? For the IWM, that was a previous head and shoulder pattern that we were looking at. It did complete to the downside and then it reversed. And it looks like there's a lot of strong momentum. And again, this is one of those situations, Chris, where you either get on the train or you just get out of the way.
I mean, you can play this through, if you want to go on the ETF side. I mean, I do it through the CFD side of things, but if you want to do that, I mean, you go long IWM, short Qs, right? So you can trade that same trade in that situation. It'd be tick for tick almost against the CFD things because they track each other. So that could be an interesting one to look at. It's one I'm going to follow.
You know what, Chris, this is something that I just topic of conversation, something that I brought up a couple of days ago. We saw, and this is in our community, we saw a big move down in the Mag 7. But if you looked at like a heat map of the entire market, all these, top technology stocks were down. Everything else was green. Almost
amazing.
Like
amazing.
90% of everything else is green.
Yeah, so something we were talking about as well. I mean, I think that just tells you about the flows. People are getting set for next year. Yeah, the thing is that tech outperformed in a rising rates environment. That's not supposed to happen. These are long duration assets with long cash flows. They don't pay massive dividends to the point they use that cash. A lot of these AI stocks like Nvidia, it's all about reinvesting the cash that they have to grow and get massive growth. But they've outperformed in a rising rates environment. And the irony now is that, you'd expect them to perform really well in a falling rates environment. It seems that everyone's doing the opposite and taking their money out, and they want to be in banks at the moment. The XLF's flying, KRE's doing quite well. So, I mean, if you're looking at the Russell, so much of the component is made up of financials. So interesting dynamics there, but you make a good point.
Very, very good. Okay. Last setup for today for me is going to be Ethereum. And, this is for your crypto bros out there. Look, we talk a lot about a line in the sand, and a line in the sand for me for Ethereum is very, very clear. That level, and let me pull up the chart here just so I have all the numbers on my screen. I thought I had it, but then it just disappeared. Oh my gosh, here it is. Okay. So, the level that you should be looking at is 2140, 2130, somewhere around there. That's that big green line you see. It's a horizontal green line. It's a 50% retracement of the last leg higher. That has clearly held on multiple accounts. So while we're above that level, and you can really, if you're going to do correlations, Chris, and you go, well, what's Bitcoin doing? If Bitcoin's not going up, then I'm not going to trade Ethereum. That's fine. Bitcoin has to stay above 40K. There's your line in the sand for Bitcoin. So while Bitcoin's above 40,000, Ethereum's above 2140, you should be looking at higher levels. And it looks like we're in this risk on environment where people are deploying cash, Chris. Why leave Ethereum out in the dark? What do you think here?
Yeah, I like it. I like it higher. There has been a decent correction. It's held that level, so I love it. I think that's the fact that it's held that level so nicely is support becomes resistance becomes support, and it's clearly shown that the market's prepared to. And I think it shows just how well crypto trades on a technical basis. I mean, I haven't seen I haven't seen a market that actually holds levels as well as crypto does recently. I mean, I think if you're looking at technicals, just even basic support resistance levels, let alone going into momentum and Fibonacci and bits and pieces, it just holds levels well. So I think technically it trades well, and the fact that it's supported there is speaks volumes. Obviously, now we've had that flush out. The ETF side of things for Bitcoin, which would feed through into Ethereum, is still very much there. I think we're expecting a decision early January on that, and of course then we go into the halving in April. So that's something that supports not just Bitcoin, but could actually flow into semantics into the rest of the scene. So yeah, I think it goes. I think the balance of risk on this now, obviously you know where your stop loss is, don't you? But the balance of risk is higher on this one as well. So yeah, I think it's a good setup, and thank you for bringing that on the radar. I think I might use that one later for clients myself. Genius borrows, talent steals, all that. Anyway, moving on. Let's go to play of the day. Right, I'm going to go to the US 500. I talked very openly about the Russell, and I like that one into dips. And that's one I want to trade. I want to be long Russell, short Nasdaq. do it for ETFs as we talked about. But look, the US 500 does the same job. And, this is I think it's 2% away from its all-time highs. I think it gets there. Do we close out 2023 with an all-time high? That wasn't supposed to happen at the beginning of the year, was it? The equities, balance sheet reduction, liquidity coming out of the market, the Fed building on its TGA, banking crisis. We weren't supposed to see the US 500, S&P breaking and closing at all-time highs. 2023 has been full of surprises, but I think there's a bit of heat that needs to come out the US 500. Maybe it comes tonight. So drawn a black horizontal level. I think that's about 3/4 of the way down through the range that we've been seeing. I want to be looking to long into those levels for a continued move higher. I mean, as it stands at the moment, the way that things are trading, I just think stay long till proven wrong or get out of the way. But I wouldn't be fighting this right now. So ahead of those flows that we're seeing in the beginning of the year, I still think the market wants to front run that. I know there's a big options expiry that takes place on Friday. One of actually probably the biggest options expiry we've ever seen. But I'm not sure that how much that's going to play into it. But right now, given this flow, given the participation we've been seeing, you can look at the market internals. This market is high on optimism, and they love what they're seeing. I think the balance of risk is still for higher levels.
Awesome, Chris. And I was just looking at your CFD. I think it's about 46.20 is the breakout point. That would be your horizontal line, right? That's the level. All right. And it's momentum, that's for sure. All right. My play of the day is going to be Crude, and this is going to be the PAL pivot play for me, because I actually think crude oil is going to end up being the Achilles heel of central banks later this year. But I did want to mention, my play of the day last week, I just got out of the remainder of my Aussie Kiwi long for almost 100 pips following the New Zealand very, very weak GDP numbers. So I scaled out of it, and my last half of it was out just about an hour ago. So I played that one to the long side, if you remember from last week. But with crude, thanks to PAL, we know where support is. Thanks to President Biden for telling us where they're refilling the SPRs. It's around these levels. That green line, that's big support. You can see divergent relative strength. Crude should, in my opinion, head higher towards the 200 DMA as we taper off into the end of the year. And like I said, we can thank PAL, we can thank the other central banks for the rise in inflation that we're going to feel in about a month from now, Chris. And so I'm going to leave it at that.
I know it's interesting you bring up the Kiwi GDP numbers, because GDP is such a backward-looking indicator. But when you see the market looking for 20 basis points of growth and it came out with a negative 30, I mean, that's a huge miss by the economists. And I think that that shows that an economy in contraction is something that the market will take notice of. So whether we get a second quarter to get you in that technical recession longer term, I think would speak volumes. But I think that was a big miss, and that did cause a bit of a ripple. Not a huge ripple, but it caused enough to warrant. I think there's still further upside, Blake, in Aussie Kiwi myself. So I think that's still an interesting trade. But I think that's one to look at. Anyway, thank you everyone for sticking around in what has been a momentous day in the markets, and it's going to be something that I think will stay with us for some time. Is this the start of a pivot? Is this the day that the Fed acknowledged a turn where they're going to look to cut rates in 2024? One of the big key thematics that we're looking at from a macro perspective. So thank you very much for sticking around and enjoying the journey with us. Leave a comment below. We love the comments. We love to hear from you in what, as I say, is a big day in markets. Give us a like if you like it. I hope you do. And we'll see you back next week for more of the trade-off.